Hello students, let's study fundamentals of insurance. This is unit 2. The lecture is insurance intermediaries. Let's study the meaning of insurance intermediaries. Insurance intermediaries are brokers or agents who represent consumers in insurance transactions. They are contracted with multiple insurance companies, so they focus on matching their clients' need with the most suitable insurance products. Now, when we talk about intermediaries, they basically form the distribution channel of the insurance industry. These brokers and agents connect with many companies because the supply of product is different into the market. They match the needs of the customers with the policies they generally sell in the market. Definition: according to IRDA, that is the Insurance Regulation Development Authority Act of 1999, under section 21F of the Act states that intermediary of insurance industry includes insurance brokers, reinsurance brokers, insurance consultants, surveyors and loss assessors. Now, let us study the different forms of intermediaries. We have insurance agents, insurance brokers, banca insurance, micro insurance agents. See the different forms of intermediaries. Insurance agents are people who generally connect with the insurance company and build the clientele for them. Insurance brokers are the commission agents. They work on the basis of the commission and the money earned in the market for any company. Banca insurance is the bank companies working as intermediary between the insurance and the clients. Micro insurance agents are for the better penetration and for the rural segment coverage. Their commission base is low, but they also form a part of the insurance distribution channel. Now is the banca insurance, that is bank assurance is the partnership or relationship between a bank and an insurance company, whereby the insurance company uses the bank sales channel in order to sell the insurance products. Bank insurance is the insurance company connecting the customers. You have the banks in the middle, and these banks are regulated by both RBI, that is the Reserve Bank of India, and IRDA, that is the Insurance Regulatory Development Authority. Bank insurance in India. In the year 2002, the banks of India were permitted to do insurance business for the first time. It is regulated both by the Reserve Bank of India and Insurance Regulatory and Development Authority, that is IRDA, as it is a combination of banks and insurance. It is a win-win strategy for both. Example, SBI Life Insurance Company Limited has a tie with SBI Bank, that is State Bank of Insurance has a tie-up with the State Bank of India. Micro insurance agents. Micro insurance or micro agent was a channel in the insurance industry that was developed for a deeper penetration of insurance into India. However, with smaller ticket size coupled with low commissions, this channel has been a kind of a low participation from the distributors. Micro insurance agent system has not become very popular because the commission paid are very low. So, even the distributors are not taking much interest to appoint these kinds of agents. So, this is not becoming a very powerful part of the insurance businesses, but still the agents and the brokers do a very important role in building insurance business for the companies. Micro insurance agents build distribution with low commissions. They build a deeper penetration, and these micro insurance agents connect the companies to the rural and to the population basis, which is generally low density areas. Intermediaries is supervisory authority sets requirements directly or through the supervision of the insurers for the conduct of intermediaries. Intermediaries for this purpose include insurance agents, corporate agents, insurance brokers, insurance surveyors, loss assessors and third party administration in health insurance. So, intermediaries, they are a kind of a powerful form of the distribution channel. This distribution channel connects the clients with the companies. Let's see the insurance intermediaries. First is the insurance companies, and here the intermediaries work in form of agents, corporate agents, brokers, surveyors and loss assessors, and third party administration. Intermediaries, they are an essential area of supervision in the insurance sector and may have a reputation risk or a prudential impact on the insurers. Intermediaries serve as an important distribution channel of insurance industry. They provide interface between consumers and insurers. So, they are the face of the industry. They talk to the clients, sell the policies and help in designing the innovative ideas and products because they understand the feedback from the customers and take it to the company. Conduct of intermediaries. Their good conduct is essential to protect consumers and promote confidence in the insurance market. Therefore, there is a need for supervision of intermediaries. Intermediaries are legal entities working into the market. Their bad reputation can impact the business and the reputation of the company. So, these intermediaries are also regulated by law. Let's see how. First is the essential criteria for these authorities. The supervisory authority requires intermediaries to be licensed or registered. This is the provision of Insurance Act Section 42 prescribes the policy guidelines for licensing. That is, no broker can work in the market without registration or a license, which is generally a kind of a requirement to have an essential holding according to Section 42. Issue of license. Authority may determine by regulations to issue license as intermediary insurance intermediary, that is Section 42D. All the intermediaries in the insurance business sector are licensed and the procedure for license is laid down in the respective regulations. So, if you are working in the industry without regulation, generally you will be punishable under law. Professional knowledge. The supervisory authority requires intermediaries to have adequate general, commercial and professional knowledge and the ability as well as having a good reputation. Now, the body that is guiding or that is giving registrations, that is the IRDA, that is the Insurance Regulatory Development Authority, requires that the agents must have knowledge and training to do business in the market. Training intermediaries. Respective regulations on intermediaries prescribe qualification, training and pre-licensing examination criteria for intermediaries to ensure that only person with adequate professional knowledge, they are involved into insurance intermediation. That is, we have certain criteria before you become an agent or you are a broker in the market. What are the criteria? We will study in details. Let's take the corrective action. If necessary, the supervisory authority takes corrective action, including applying sanctions directly or through insurers and cancelling the intermediary's license or registration when appropriate. So, these regulatory bodies not only impact the training and the qualifications of the brokers and the agents, but they also have the power to take corrective action. That is, if they do wrong or they misbehave in the market or their misconduct is reflected, they can cancel the license of the brokers and the agents. Code of conduct is generally prescribed. Regulations prescribe code of conduct for respective intermediaries. The Section 42D in the Insurance Act of 1938 and relevant regulations prescribes actions for violations which include penalty, suspensions and cancellations. The Act of 1938 generally lays down the guidelines for the misconduct and the misbehavior of the agents where they can be punished under law. Safeguarding funds. The supervisory authority requires an intermediary who handles clients' money to have sufficient safeguards in place to protect these funds. Protection of these funds is essential. Risk management policy. The Section 64(5)(b) mandates that the risk in policy of insurance will commence only after receipt of premium by insurer. Further, under provisions of this section, any intermediary who is authorized to collect insurance premium shall deposit with or dispatch by post to the insurer the premium so collected in full without deduction of his commission within 24 hours of the collection. So, this section basically tries to manage the risk and safeguard the funds, where within 24 hours you have to report the funding to the insurance company. Brokers Regulation Act of 2002. Regulation 23 of IRDA, that is the Insurance Regulatory Development Authority, Insurance Brokers Regulation Act 2002 prescribes the manner in which money collected by insurance broker shall be dealt, and it ensures enough safeguards with regard to the funds. So, this is important that basically when the agents collect money, first the funds have to be given to the company and then the commission can come to them. Intermediaries Roll. The supervisory authority requires intermediaries to give customers information on their status, significantly and specifically whether they are independent or associated with particular insurance company, and whether they are authorized to conclude insurance contracts on behalf of the insurer or not. It is important for the brokers to give their introduction to the clients. To which company they are associated is the basic requirement that they should give in their introduction to the clients, and if the clients understand them, then only they can sign the contract for him. Idle sales practices. Under provisions of regulations which prescribe code of conduct for respective intermediaries mandates that the intermediary shall identify himself and the insurance company of whom he is an intermediary. Code of conduct prescribed for insurance brokers specifically in matters relating to sales practices. Controlling fair practices. The supervisory authority or other authority must have powers to take action against these individuals or entities that are carrying on insurance intermediation activity without license or registration. Section 42 of Insurance Act of 1938. As per Section 42D(8) of Insurance Act 1938, any person who acts as an intermediary or an insurance intermediary without holding a license issued under this section to act such shall be punishable with fine. So, this act basically gives you the requirement of holding a kind of a valid license. Section 42 of Insurance Act of 1938. Further, as per Section 42D(8) of Insurance Act 1938, any insurer or any person who appoints as an intermediary or an insurance intermediary or any person not licensed to act as such or transacts any insurance business in India through any such person shall be punishable with fine. So, this is only appointed people by the company under particular sections, that is section 42 of the Act 1938. They have the power to do business, and if you work without this licenses, you generally are liable to be punishable under law. Regulation of 17 of IRDA, that is Regulation 17 of Insurance Regulatory Development Authority, that is IRDA. Insurance and brokers provide for penal action under Act for any person who acts as insurance broker without holding valid license. This action is without prejudice to initiation of any criminal proceedings against the said person. So, this section 17 of IRDA basically initiates that license is essential, and you generally need to have a kind of a valid approval from this authority to work in the business of insurance. Compensation. Compensation is a systematic approach to providing monetary value to employees in exchange for work performed. Compensation may achieve several purposes assisting in recruitment, job performance and job satisfaction. Now, because we are reading insurance business, it is important that the intermediaries, that is the brokers and agents, need payment also. So, what is their payment and what is the compensation management, or what is the system? Let us see this in detail, where we have studied that this is a systematic effort to give them wages and salaries. Objectives is to recruit and retain qualified employees, to increase and maintain morale, to determine basic wage and salary, and to reward for job performances. That is, what is the objective for giving compensation is to generally have employees who have talent and they are retained in the industry. Compensation is an integral part of human resource management, which helps in motivating the employees and improving organizational effectiveness. Effectiveness in terms of attracting and retaining talent, motivating talent for better performance and cost effectiveness. So, if the insurance industry has good compensation management system, is good brokers and good agents will work for the industry and the business will go high, which will give a national wealth. Factors affecting compensation is mental requirements, physical requirements, skill requirements, responsibility level, working conditions, that is the risk, time and the hazards you face. How do we determine the compensation of any industry people? Basically depends on the skills required to perform a particular job, and it is the professional ability of the people who are associated with the industry. Purpose of compensation for the employer is to build a brand name for attracting candidates, motivating employees for higher productivity and performance, retaining talent, consistency in compensation and provoking healthy internal competition. Why the insurance companies need to give good compensation is to retain good employees and to build a kind of a business potential or the sales level which is required for the performance of the basic competitor or the basic business entity in the market. Factors affecting compensation is organizational affordability, that requires manpower planning, sales and salary ratio, market rate for the talent and the economic condition. How insurance companies decide their compensation for the brokers and agents depends on the prevailing economic conditions of particular country. The salary is decided in ratio to the sales generated by each agent. For employees, compensation is important to maintain a work-life balance. Recognition is a tool for self-esteem and planning for better quality of life. Now, here let us see the total detailed structure of compensation management, where the employee management generally is important for the legal compliances, for image building, branding, consumer satisfaction, relationship management, building equity in market, for better administration and for creating efficiency in the market. Indirect compensation relates to protection programs of life insurance, medical insurance, pension and social security. See, when we manage compensation for the intermediaries, that is for brokers and agents, we have direct compensations and we have indirect compensation. So, the indirect compensation will be the protection programs generally which are implied for those agents also in form of life and medical insurance to build their pension and to build a kind of a security for them. Pay for time not worked, that is holidays, vacations and sick leave. These brokers and the agents also get these indirect benefits working in the industry. Services prerequisites, that is the recreational facilities, car, financial planning and low cost lunches which are associated with their business. Direct compensation is the wages and the salaries given to the brokers and the agents, that is the base pay is the wage plus salary. Incentive payment requires or basically it is built up by adding bonus plus commission plus stock option plus profit sharing. Deferred payments are savings plus stock purchase plus annuity. So, this is the advantage that how the intermediaries work into the market. This is the basic pay compensation or the money mechanism which builds the distribution channel for the company, and this is how the clients connect to the brokers, because the brokers have the vested interest of getting an effective compensation which is designed by the insurance industry to retain the workforce. Direct compensation refers to the monetary benefits offered and provided to employees in return of the services they provide to the organization. The monetary benefits include basic salary, house rent, allowance, conveyance, leave travel allowance, medical reimbursements, special allowances, bonus, PF, gratuity, etc. They are given at a regular interval and at a regular time. Indirect refers to non-monetary benefits which is provided to employees in lieu of services provided by them to the organization. They include paid leave, car, transportation, medical aids and assistance, insurance, leave travel assistance, retirement benefits and holiday homes. On any standard policy that you procure shall be paid for the following commission rates: 35% of first year premium installments, 7.5% of second and third year installments, and 5% of every year till maturity of the policy. So, this is the basic attraction, that this is the basic way why the industry works in an effective and an efficient way, that the brokers do have a profit sharing in the business. Whenever they give a premium to the company, that is they give 35% of the share as a part of the business, and then even if after retirement if they are not in the business, the premium and the interest or the kind of the sharing will come to them with 5% added to each year. And the furthermore the impact is high, like if they have a nominated person and if the agent dies, then the benefits will be transferred to the kind of the offsprings or the nominees. The intermediaries who work in the insurance businesses give profits to the clients, they give profits to the companies, but they themselves also have a kind of a big impact in terms of savings and returns. They get payments in form of direct commissions, they get indirect benefits in terms of security and the insurance coverage. So, this business basically is lucrative for the agents and the brokers who generally involve lot of time with the companies and sharing their kind of work hours with the clients also. The businesses go beyond working to relationship building, where the management is basically related to the client aspect, and here customer relations are important for the client sustainability. When we study the insurance business in detail, we see that the intermediaries who relate to the kind of the crystallization of sales and they do a business for the company, both are benefited. The company gets enough investments which roots back to the national and the economic development, and the agents and the brokers get money, wages, compensation and other security. This is how the insurance intermediaries work in market, with effective compensation systems and with effective management systems to crystallize sales in the market. Now, let us study the summary of this lecture. In this lecture, we have studied the insurance intermediaries and the compensation system they generally get. Intermediaries are important in the sales business to crystallize the insurance or the policy claims for the company. The clients generally are dispersed. Now, it is important that they need to connect with the customers with a planned meeting and try to negotiate the terms for policy building. These intermediaries in form of banks, micro agents, brokers, consultants and surveyors work in the market for the benefit of the company. They crystallize the money and build the wealth for the company. This wealth is important for the nation, and if wealth is important for the nation, the brokers and the agents are also important for the country. The insurance business cannot run without intermediaries. The distribution channel is important and it generally brings lot of money for the company. The agents have to work for customer satisfaction. I hope the students must have understood the impact of intermediaries and compensation management. Thank you, students.